Welcome and thank you for joining us for this 401k presentation. I have Kendall Storch from Longfellow Benefits, now Arthur J. Gallagher and Company, with us today. At this point, I'll turn this presentation over to Kendall, but I will go ahead and encourage you, if you do have questions, there is a question feature on your GoToWebinar tool. So if you do have questions, please feel free to type in your questions, and we'll try and get to as many as we can following Kendall's presentation.
That sounds great. Thanks, Colin. I appreciate it. Thanks, everybody, for taking a little bit of time here today to go through our first quarter update. I'm moving us to our agenda slide here so you can see what I'll be talking about today. But to begin with, we'll do a brief overview of the markets for first quarter of 2016. We'll talk a little bit about where there was strength, where there was weakness. We'll look at some trends and some outlook for the rest of the year. The second thing we'll take a quick look at is some of the performance on a number of the different DSO funds. We'll look at actually all the funds, but I may make a couple of quick comments on some in particular. And then finally, the rest of the presentation is really around what I call turbocharging your 401k. So these are just some ideas of how you can try to get more out of your 401k, whether that's by finding ways to increase contributions, whether that's by using some of the tools and capabilities that we have on the Fidelity website, whether that's by using some of the resources to better adjust your investment picture. I'll go through some ideas for you there and see if maybe there's some opportunities for people to make some tweaks. From there, we'll see what kind of questions we have. We'll open up the lines, or we'll probably have Colin read off some of the questions from the chat box. And our goal will be to wrap this up by 3 o'clock Eastern time, so we'll take about an hour to do it. So we'll start with a quick market overview. So as you can see, we had kind of a rocky start to 2016, and that anybody who was kind of reading the papers, etc., for the first quarter of the year, this is no surprise. But I think what I would do is just draw your attention to the top part of the screen, where we have the returns for a variety of different types of investments for first quarter, working their way down from best to worst. So I think kind of one of the things that you might note as you look at the returns here is that essentially some of the things that typically are more conservative type investments, bonds, real estate, gold, things of that nature, those were the components of the market that tended to outperform. The riskier aspects, or the riskier components to the market, equities, commodities, international stocks, all were the worst performers. So when we look at our kind of risk meter here for first quarter, really this was a risk-off period of time. It was a period of time when the more defensive elements of the market tended to hold up. So I'll make a couple other quick comments, but if you were to draw a graph of what was happening with the markets for first quarter, it would be basically a V shape. January started out extremely rocky. In fact, it was the worst January on record going back to 1926. So we had an extremely tough start to the year, and that was for basically two primary factors. Number one, the market was concerned about global growth. The market was worried that the global economy was slowing. And because of that, the market was giving back some ground from fourth quarter of last year. With that, the market was also concerned about China. China has been sort of an ongoing concern for the past, I'd say, 12 to 18 months at this stage. But China is the second largest economy in the world, so we keep a pretty close eye on sort of what's happening with China, because they're a big piece of the entire global economic picture. So the outlook for China at the first portion of the quarter was not necessarily looking so good, and there was a lot of concern about whether the Chinese economy was slowing and how rapidly it was slowing. As we get to late February and early March, the markets begin to turn around. And that was, again, for a couple of reasons. Number one, we saw interest rate cuts not only in Japan, but also in Europe. And that's a way to try and stimulate those economies. And then secondarily, from the U.S., from the Federal Reserve, the sort of the stance or the rhetoric from the Federal Reserve became less harsh in terms of whether they were going to start more rapidly raising interest rates. I think as we came into first quarter, the tone began to soften a little bit, and Janet Yellen, who's the chairman of the Fed, was making indications that they may lengthen out the time frame by which they're going to raise interest rates. So the market was encouraged by that, and as a result, the markets rebounded and rallied really into the very end of the quarter. So as you can see on this chart, U.S. large cap stocks, we're representing that by the S&P 500 index, eked out a gain. It was up 1.3% for the period. So we managed to recover a lot in terms of what we had lost. As we sit here today, from kind of peak to trough, since the start of the year, the market has moved about 13%. So at one point, we were down nearly 13% since the start of the year. So the market has recovered quite a bit from there. But I think that also gives us, some perspective on the amount of volatility that we've had coming into 2016. Couple other kind of areas for us to sort of focus on. Again, this is really looking at just U.S. stocks, but you can see the returns here for first quarter, and then at the bottom of the screen are the returns for the 1 year ended the end of March. So a pretty positive territory, more or less, other than for small caps for the quarter. As we get into our 1 year look, it's a bit of a mixed bag, where basically smaller companies or more value-oriented stocks are still in negative territory, and it's really more large U.S. and more, I guess you could say, technology-oriented companies that still have positive returns, and of course, and REITs as well. So that would be real estate investments. I'll talk about that in a little bit. One of the other things that we tend to look at when we're looking at the market is, does the market look expensive? How fairly valued is the market? So as we're looking at this chart, you can see the 20-year average of the stock market is that orange line. The long-term average, going back to 1925, is the yellow line. And then we have the price-earnings ratio for the S&P 500 index plotted in green. So not sure if you're able to see my cursor here, but if you look all the way at the end of 2016, you'll note the green line is slightly above the 20-year average. So by no means does the market look overvalued at this stage. If you look at the big kind of hump in the middle of that chart, that's 1995 through 2000. So that was the internet bubble. Now that's a pretty true bubble. So that's a period of time certainly when the market was way overvalued. And anytime you have a bubble scenario, you have both the good, that could be the side of the chart climbing the mountain, and then you have the bad when the bubble bursts. So it does not really appear, based on the graph that we have, a similar picture. Market looks relatively fairly valued as we sit here today. Okay. Another area that we can look at is specific industries and how those industries performed. So we have the industries listed here across the board. I think, again, the same theory holds true, that as we look at specific sectors, it's really the more, again, conservative or defensive sectors that led the way. So telecom, utilities, consumer staples, those were really the top performing sectors for the quarter. The ones that did not perform necessarily as well, consumer discretionary, financials, healthcare, these tend to be industries, if you will, that are a little bit more economically sensitive. So as we look at the performance of some of the different funds that we have as part of the plan, you'll note a theme. Basically, if you own funds that were light or underweight on some of these more defensive sectors, such as telecom, utilities, and consumer staples, chances are those funds did not hold up as well. They weren't able to keep up. And we did have a couple funds that look like that, and I'll mention that a little bit later on, or I'll point to them. But this is, I think, a good explanation as you look at performance. One thing that you can double check, I guess you could say, is sector weightings. If you don't see much in telecom, utilities, or consumer staples, that's going to explain a lot of where the performance was coming from. I think a second thing to note, though, is a bit of a role reversal from what we had last year. So for the past, I want to say almost 3 years right now, healthcare has kind of led the charge. Healthcare has been one of the top performing sectors. This quarter, healthcare was the worst performing sector. So a bit of a role reversal there. Financials for the second half of 2015 was also a very strong performer. A lot of that was predicated on the fact that the federal government was going to raise interest rates. As we moved into first quarter this year, the outlook for extended interest rate hikes backed off. So the rationale around this is if you're a bank and you're lending money out and you can lend money out at a higher rate, that is going to help your profits. If interest rates don't rise, then you're constrained in terms of what you can charge for loans. So there was anticipation that banks were going to be able to charge more on loans. That bubble kind of burst first quarter, and as a result, financials pulled back. I'll make one other little comment before I move to my next slide, but there's kind of a reason why telecom and utilities in particular, and to some degree energy, looked attractive for first quarter. And a lot of that has to do with yield and what kind of dividends those types of stocks pay out. So if we kind of flip the chart here and move on to fixed income and look at the bond picture, it's interesting to kind of see where bonds were relative to stocks. So as I mentioned before, the S&P 500 index was up 1.3%. Basically, all of the bonds that I have listed outperformed that. So while both stocks and bonds were positive for Q1, bonds were certainly the stronger performer. So why was that? The reason for that primarily was because interest rates on bonds or yields on bonds actually went down first quarter, which was kind of a surprise. So just as a reminder, the federal government raised interest rates for the first time in 6 odd years in December by 0.25%. So we have an interest rate increase. But even with that interest rate increase, the interest rate on, say, 10-year government bonds actually went down. So how can that be? The rationale for that, or the explanation, is really around demand, that there's an extreme amount of demand for U.S. government bonds right now. And I'll show you a chart in a second that explains why that might be the case. So I mentioned before, if you look at 10-year government bonds, that interest rates went down. So right now, a 10-year government bond is paying about 1.8% interest. So you're locking your money up for 10 years and receiving 1.8% interest on that. If you look at, for example, utility stocks, or if you look at telecom stocks like a Verizon or an AT&T or something like that, you may very well be able to find stocks that pay a higher dividend rate than U.S. government bonds. So this sort of seek for yield is part of what was driving people to those specific sectors. It's because you can get a higher yield with certain types of stocks than you can out of bonds these days. So back to my point about, how can it be that interest rates went up, but yields on bonds actually went down? All right, this is a messy chart. I apologize for that, but I will try and walk you through it so it makes some sense. But what we're showing here is what interest rates or yields look like for different types of bonds in different parts of the world. So if you look at the 1-year column, which is the second column on my chart, you'll see various different other countries. These are primarily developed countries. And you can see the interest rate that their 1-year bonds are paying. Note, majority of them are paying negative interest rates. Essentially, you have to go, there's basically just 3 countries right now between the U.S., Japan, and Europe that actually have a positive interest rate for 1-year bonds, and that's the U.S., the United Kingdom, and Portugal. So this, to me, I think is a very interesting chart because it explains why there is so much demand right now for U.S. government bonds, even when it's only paying 0.59%. It's still better than basically everything else. The other thing to look at is how far out these negative returns span. So I will take Germany, for example. You basically have to lock your money up for 9 years before you get a positive yield, before you get a positive interest rate. Basically, anything short of that, you're giving the German government $1 and they're giving you back 90 cents. So just for the privilege of kind of parking your money with the government, you don't get back what you put in. So this is the environment that's out there. And as a result, it's kind of creating this artificial demand for really anything that is paying a positive interest rate. So I thought that was pretty interesting. The second thing that I'll just mention about this chart is the lower left-hand corner. So what this is showing is sort of the federal, the Fed's consensus about what they are going to peg as their interest rates. So you can see these projections, I guess you could say, for 2016 out to 2019. And these are, we've plotted the dots for each of the different committee members as of 2016, or the last committee meeting. So that's what the Fed thinks where interest rates will be in the future. The red line is basically what the market believes interest rates are going to look like in the future. So you can see there's a pretty wide disconnect between what the Fed Reserve Bank is telling us they think interest rates are going to be versus what the rest of the market actually believes. The rest of the market believes that interest rates are going to be significantly lower than where the Fed is telling us they're going to take rates. So the market basically doesn't believe the Federal Reserve's estimates or what their intentions are. They think it's going to be a much slower move towards higher interest rates. Couple quick comments on international stocks. So as you can see, a pretty different picture here relative to kind of the U.S. picture for the quarter. So Canada was basically the big winner, at least in terms of developed countries. A lot of that has to do, again, with energy. So much of what Canada, or a big chunk of Canada's exports is oil, and we saw an uptick in oil prices first quarter. So that really benefited Canada. Outside of that, though, we have essentially negative returns across the board, whether we're looking at small companies in Europe, whether we're looking at Europe as whole, whether we're wrapping in Canada, Australia, and Japan, that would be the EFA index, or just Japan as a whole. So the international side certainly does not look nearly as strong. I think I would refer you back to the previous chart when we look at bond rates. Again, there's a reason why people are interested in the United States. Bit of a nice trend upward, though, for emerging markets. So emerging markets have struggled Again, the last probably 24 months, a lot of that having to do with commodity prices, that commodity prices have been very low, as well as a strengthening U.S. dollar. We saw commodity prices, again, in the form of oil, in particular, tick up first quarter, and we also saw a bit of a decline in the dollar, so that helped many of the emerging markets. So we saw some pretty strong returns coming out of emerging markets for first quarter. I just wanted to put this chart up as well. So I gave you a similar chart earlier looking at valuations. This chart, particularly on the right-hand side, or I guess for that matter, maybe I'll look at the left-hand side. That might be a little easier to read, is again around valuations, but for different countries. You can see the orange diamond, which is where the kind of price-earnings ratios are for these different countries today, and then we have the 20-year band. And for many of these different countries where the valuation looks or sits today is at the lower end of the band. There's just kind of a few. If you look at Mexico, you look at the Philippines, to some degree, the U.S. is right in the middle of the bands. Basically everybody else is trading towards the lower end. So one could make an argument that international markets to some degree look relatively cheap. We can kind of see that again on the chart on the right, where we have the orange line is the EFA index and what its 20-year trailing average looks like, and then you can see the orange graph, so it's trading below. Same with the green, that's emerging markets also trading below. So one could argue that there is perhaps some opportunity with international markets these days and that you're not buying particularly high. But obviously, as we saw with the previous chart, that comes with some volatility. I think international markets, while improving, still have some risks that the U.S. markets don't necessarily have. I always like to put this chart up on the deck here for people to see, but this is the periodic table of returns. So essentially what it's doing is showing the best performing investment year by year. That's the top row, and you just have to translate whatever color is in the top row to the legend on the right-hand side. So for 2016, the top performer was the purple color, which happened to be real estate stocks. For 2015, it's the gray color, the lighter gray, which was growth stocks. So the way that you interpret this chart is you'll note that there is no one color that is always at the top of the chart. There's no one color that is always at the bottom of the chart. The colors move around. So if you look at the white block or the little white blocks, that is a very simply diversified portfolio, roughly 60% U.S. large cap stocks and 40% investment grade bonds. Many of the little blocks here will trade kind of through the middle of the chart, so it's sort of the Goldilocks combination. It's not too hot and not too cold. So a couple quick points on outlook and how are we supposed to interpret some of this data. I would draw your attention to the Q2 2016 column. So we do believe that that the global economy is stabilizing. We are seeing some things there that will hopefully help the global economy, particularly with commodities, with oil prices beginning to come up. Any of these oil exporting countries will be benefited by that. The increase in oil prices may also create an inflationary effect, which, as it sits normally, people tend to think that inflation is a bad thing. For right now, where we have exceptionally low inflation, it may actually be a bit of a good thing. So to see prices rise a little bit is probably a good thing for the global economy. It will allow central banks to raise interest rates, which, as we saw before, most of the globe right now has actually negative interest rates, which over the long run is probably detrimental to their economies. So to be able to put the central banks in a position where they can actually raise rates and put some, I guess, kind of gunpowder in their arsenal to fight any potential recessions in the future is a good thing. So we look at that as a positive. The U.S. economy still looks relatively sturdy. It's slow, steady growth. Roughly 2% growth rate is sort of what we're looking at these days. So it's by no means shooting the lights out, but it is still enough to continue to create jobs, drive down the unemployment rate. I was just noting before that since 2010, the U.S. economy has actually added about 14.4 million jobs. The Great Recession, so 2008 through 2010, we lost about 8 million jobs. So we're still net positive in terms of the number of jobs that the economy has created since 2008. So that's all also positive. So China, Europe, China seems to be showing that, or Europe seems to be showing that maybe they're beginning to stabilize to some degree. Certainly a stronger dollar will help China. Their exports will look, the stronger dollar will help Europe. Their exports will look a little bit cheaper, which might help their economies. And then China being kind of our biggest risk. We certainly are hearing from China, or the moves from the Chinese government seem to indicate that they're going to do kind of whatever they need to do to try and keep growth intact and keep the economy intact. So we're hopeful that ultimately will continue to happen. So, the outlook, I think, it continues to be sort of the slow, steady growth. Hopefully, we may see, oil prices moderate a little bit more. And by moderate, I actually mean go up rather than go down. That would be a help for a relatively large chunk of the U.S. economy. About 16% of the S&P 500 index is energy related. So if we see a boost in oil prices, 16% of the S&P 500 index would improve. So there are definitely factors out there that I think are encouraging. So let's take a look at perhaps how some of this is impacting some of the funds in the plan. So I have listed here, these are the returns for, and it spans 2 different slides for the different funds that we've got. I highlighted in green any funds that outperformed their benchmark. I highlighted in red anything that underperformed its benchmark. So at least on this slide, I think the green is outpacing the red. So I think we have more here that are doing better rather than worse. I'll give you a quick preview of the other slide. Here, a bit of a mixed bag. Interesting, particularly with the target date funds. We have some, particularly the lower end target date funds that were kind of outperforming their peers. The longer term target dates came in a little bit under. A lot of that really has to do more with the stock to bond ratios between these. So T. Rowe Price tends to have a little bit more money in stocks and a little bit less money in bonds than their peers. So as we saw before, for first quarter, the more you had in bonds, probably the more edge you had over stocks. So the longer term target dates, which tend to have more money in stocks and also tend to have more money than similar funds like them. If we had a 2040 fund that had a little bit more money in bonds, that would account for why the performance numbers are a little bit higher. I did mention before, I just point out a couple funds back to those sectors and some sectors that did well, sectors that did not necessarily do well. So I'll take let's see, the Fidelity Advisor New Insights, which actually had a very good quarter. It was down 0.8%, but the peer group was down 2.45. New Insights was a little slow last year. A lot of that really had to do with one of the portfolio managers. So there's 2 portfolio managers on this fund. Will Danoff, who also runs Fidelity Contra, and John Roth, who is more of a kind of a smaller company specialist. John Roth is also more of a value manager. So some of the things that he's been doing over the past 12 to 18 months has actually been adding to his energy positions. So he's been buying some energy stocks because they look very cheap right now. For last year, that was a drag on the portfolio. But for the first quarter, and with a bump up in oil price and therefore a bump up in energy, some of those bets paid off. So the energy segment of New Insights has been a boon for that particular fund. So that's where kind of the sector plays kind of worked out. If you look at the Wells Fargo Discovery, we have sort of the opposite, where Wells Fargo Discovery does not have any real estate investments as part of the portfolio and is light on utilities. Doesn't typically go there, so to speak. That's not really part of its strategy, is to look for particularly defensive kind of sectors. It's looking more for growth. So because it didn't really have some of those sectors which were particularly strong, it underperformed some for the quarter. So two little examples of a couple of funds where, again, those sector weightings made a difference. But again, I'm just looking at a 3-month period, so this is pretty short. If we go to a longer time frame, I think we can get a better picture of what the consistency story is here. So here, I'll focus your attention on the column that reads percent rank 5-year. So this is what percentile each of these different funds fell into on a 5-year basis. So we have both up market and down market in here. The way you read this is small numbers are good. So I will take the first one on the list, the T. Rowe Price Retirement Balanced, ranked in the top 38th percentile. So that means that it beat, let's see, 52%, 62% of all the other funds like it. So that's above average. If you scroll down that list, you'll note we only have one fund, at least on this particular slide, that is in the bottom half of its peer group on a 5-year basis, and even at that, it's just barely into the bottom half. Many of the other funds here are squarely in the top half, some even top quartile. If we continue on to the next slide, again, that trend continues. Here we don't have any funds in the bottom half of our peer group, and particularly the target dates, those T. Rowe Price target date funds all look excellent, top decile across the board. So a little bit of volatility, certainly for first quarter, but the long-term results here look very sound. Okay. So I'm going to move to the third component of the presentation here, which is just some ideas on how you can maybe get a little bit more out of your 401k, or some things to contemplate to, as I say here, turbocharge your 401k. So one area that, a common question that I tend to get as we talk to employees is, how much should I be saving? What should I be targeting as a contribution rate? So what we like to tell people is 15% of pay is sort of our target, or what we believe is sort of an optimal savings rate. That 15%, keep in mind, is a combination of not only your own contributions, but also any company matching contributions. So Dassault provides a match of 50 cents on the dollar up to the first 8% of pay. And that would be equivalent to 4%. So really, if you're contributing 11% of pay, and Dassault is giving you another 4, that puts you right there at that 15% level. So we believe that 15% mark is what to kind of strive for. That said, the point of this is not necessarily for everybody to run out and suddenly move their contribution rate up to 15%. I think it's more just to give people a target. Certainly not everybody is in a financial position to be able to do that. So we'll talk about perhaps some ways that you kind of slowly move the dial. Why 15% of pay? Are we picking this number kind of out of thin air, or is there any sort of science behind it? The good news is there is some science behind it. In fact, there's a multitude of economic studies or academic studies that look at this kind of question, which is ultimately how much should people be saving. I'm quoting some of the work of Dr. David Pfau, who is a professor, and he has a variety of different research about this particular topic. So I'm quoting one of his publications here. But basically, what he found is if we're trying to target a pre-retirement income replacement rate of 85%, we're expecting 35% of that to come from Social Security, which leaves basically 50% that people would need to fund on their own. That 50% would come from your 401k account or an IRA account or a pension plan or something like that. So what his research basically showed was at 15%, that gave essentially the highest probability of having enough money at retirement age to replace 50% of your pre-retirement income. A couple of caveats with that. His research is also was focused on somebody who was age 35, so that 15% number is going to move around, certainly with your age. If you're 55 years old and you've never saved a dime for retirement, chances are 15% isn't going to get you there. You'd have to do much more. Conversely, if you're 25 years old, you may be able to do somewhat less. But the idea of this is really just to give us sort of a rule of thumb and something to kind of work off of. So that would be kind of a number for people to put in the back of their heads as something to kind of aim for. One thing that you might say to yourself is, based on my income, I can't actually put 15% into the retirement plan because I get capped out with the IRS limits. So for this year, that IRS limit is $18,000 if you're under age 50, and then $24,000 if you're over age 50. So, these might be some areas that you could go to if you're already maxing out your 401k, and you could make a traditional IRA contribution. Perhaps, if you qualify, you can make a Roth IRA contribution. I think last spring, I talked a little bit more in depth about sort of this concept, but using the HSA as a sort of a retirement offset vehicle, that might be another place where you could save some dollars, or you could open up just a regular taxable account, use that to supplement what's happening with the 401k plan. So if you can't get to that 15%, there are other vehicles that you can go to try and get to that 15% number. So another question might be, how can I figure out if this is even affordable for me? Can I afford to do 15%, or am I going to be eating cat food to be able to get to that level? So there's a calculator right here on the Net Benefits website, the take-home pay calculator. So I have a little screen print here under the contributions tab. You'll see this take-home pay calculator, and it looks like this. So if you enter your annual income and your pay period and your tax rates and how much you're contributing, it will show you this is the impact on your paycheck. So for this particular person making $75,000 a year, if they contributed 5% of pay, that would be $144 per pay period that would go into their 401k account. But their paycheck would only go down $101 because this is a pre-tax contribution. So you can use this tool and vary the contribution rate to test out, I'm doing 8% of pay right now. How much is it going to cost me to go to 9%? Can I afford that? How much would it cost me to go to 10%? Can I afford that? So this might be a tool that people can use to kind of model out the financial impact of making a change to their retirement contribution. Okay, once you've modeled it out, maybe you find, I can afford to go from 8 to 9, but I can't really afford to go from 9 to 10. This might be a time to kind of take a look at the budget. So, kind of our thinking around budgeting is, roughly 50% of your take-home pay should be allocated to essential spending. Essential spending is ultimately going to be, your mortgage payment, any of your fixed costs, the cable bill, the electricity bill, etc. That usually falls under what we'll categorize as essential spending. 20% should be set aside for retirement. 15 of it would be 20%, I should say, should be set aside for retirement and an emergency fund. So we're thinking 15 towards a retirement plan, 5% towards some sort of an emergency fund, and then whatever you have left over would be discretionary income. That's kind of where you would go to see, okay, after I pay all the bills and set some money aside for my future, do I have anything left? If I do, can I take any of that and use that to try and raise my contribution rate? So what if you discover, my discretionary income or whatever I have left over is zero? I've got nothing left. That's fine. And as I like to say, Rome was not built in a day. So we're not expecting people to suddenly switch from, again, 8% contribution to 15. If you can afford to do it, great. But if you can't, don't feel bad about that. There are ways to kind of get there over time. So one way that you can do that is to use this annual increase program. This is, again, a tool on the website, also under the contributions tab, where you can automatically code your account to raise your contribution. So you can go in and say, all right, on such and such a date every year, bump up my contribution by a percentage or 2% or something like that. So many times people will time this with merit increase or bonus time, where they have a little extra cash at that stage, particularly if there's a merit increase. If you get a 3% raise, you take 1% out of it, put that towards the 401k plan, and you should still feel roughly in the same position from a take-home pay perspective. So this is a way to kind of slowly work towards that 15% number. So I just wanted to kind of point out, even that an extra 1% can make a difference. So what we have here is different contribution rates and what those levels might grow to. In this case, we're looking at a 25-year time frame, but small changes in contribution rates, if you have the time to let that money grow, adds up to big differentials. So that's why I'm trying to emphasize, even if you can go from 8 to 9, that'll make a difference. It may seem small, but if you have time to let that money grow, at the end of the line, that can account for a pretty big extra chunk of money that wouldn't have been there before in the first place if you didn't make that change. So how do I know if this is going to work? All right, it sounds great. Adding some extra money to my 401k plan, is it really going to help? Is it going to do anything? Surprisingly, there's a tool. Again, on the Fidelity side, on the net benefit side, this is the Retirement Income Simulator. So you can use this tool to model out whether you're on track or off track. And you can find this tool in the library section under tools and calculators. There's, shall we say, kind of a questionnaire at the beginning to gather some information about yourself. If you're married with your spouse, you can build in not only your own Dassault 401k account, but also any other retirement accounts that you might have. You can model out different interest rate scenarios, inflation scenarios, etc. And at the end of the day, it will give you a synopsis of, if you keep doing what you're doing, how long will the money last? And will you be able to get there? Is there any sort of a shortfall? So, a tool like this is a good way to test out, all the other things that we were looking at before. If I can afford to raise my contribution, will it get me there? And what about the investment piece? Do I have the right mix of funds? To some degree, the younger you are, the mix becomes a little less of a concern because we can essentially rely on time to do most of the work for us. And I'll just kind of flip to this slide to make that point. But over long periods of time, these have been the long-term rates of return for different types of investments. So for a younger person, if you have more money in stocks, which is typically going to be the case, we can bet on long-term rates of return because you have a long time before you're going to retire as anticipation of what that piece of your portfolio is going to grow at. So, we can kind of bet on time the younger you are. The older you are, where we don't have as much time, then it becomes more a question around the asset allocation. We have to make sure that we've got the right mix, not so much that we're growing the money as fast as we possibly can, but we're also trying to protect the money that we've already accumulated. We don't want to dig a particularly deep hole for ourselves. So that's essentially what this slide is showing us. If you look at the best and worst 12-month periods and 5-year periods, there's a pretty big difference, I guess you could say, in terms of downside between the most aggressive portfolio and the most conservative portfolio. So the older we get, the more we begin to look at the downside. The younger we are, we're really kind of concentrating on the upside. Again, is there a way to test this out? Is there a tool that you can use to scope out whether your portfolio is on track or off track? The answer, of course, is yes. Again, in the tools and calculator section of the net benefit site, there's a portfolio review tool. I have a little screenshot of this. It will take a look at how your portfolio is currently allocated, and if you answer the risk tolerance questionnaire, it will give you sort of a proposed allocation. So this is a tool that you can use. You can certainly reach out to myself or any of the other members on our team if you want to talk to somebody and go through this or get our take on what your current portfolio looks like versus perhaps a different portfolio. And the nice thing about this tool is, again, it will kind of model out, best case scenario, worst case scenario, so you can see what changes to the portfolio will do in terms of your upside as well as your downside. So those are, I think, some easy ways to think about how you can perhaps increase your contribution rates, model out whether or not you're on track or off track, determine whether changes to your contributions are affordable, make sure that you have sort of the right investment mix. Any of these things would be ways that you can kind of, like I said, turbocharge the 401k. So with that, I think I will wrap up on my prepared comments and maybe turn it over to Colin to see if we have some questions that I can try to answer.
Absolutely. Thank you, Kendall. And just to get started with, the number one question that comes up all the time is, will this presentation be made available, both the slide deck as well as the recordings? And the answer to that is yes. We do post these out to the rewards at 3ds.com website, so you can look for that either tomorrow or Monday. Certainly by the end of Monday it should be posted. The other question, again, that I'll start with before we move into Kendall's questions is there are some locations that from time to time individual employees get calls from an investment advisor. And Longfellow Benefits / Arthur Gallagher, who Kendall works for, that is our only investment advisor that Dassault Systems has an agreement with. So if you're getting calls from anybody else, please take down their name, their phone number. You can certainly pass it along to me. You can pass it along to your local HR, and I'm sure they'll get it to me or to somebody else on the benefits team, and we can certainly make sure that that gets addressed with that organization, because we don't take phone calls or solicitation from other investment advisors. So for any of you that are getting those calls, please go ahead and let us know so that we can reach out to them and ask them to stop. So now we'll move into some of the questions that are probably more specifically for Kendall, and the questions are absolutely rolling in at this point. So we'll start with the first question that we have, and we'll get to as many as we can. with the decline really in the coal industry, the fossil fuel industry, and with the recent climate change agreement that came out of Paris, do you expect Dassault Systems to be offering any sort of fossil fuel-free investment options?
At this stage, I don't. Our philosophically, Dassault has always sort of taken a position that our intent with its offering investment options has then tended to be something relatively broad. And so we've tended to stay away from kind of sector-ish type funds. So we don't have a gold fund. We don't have necessarily a real estate fund or a healthcare fund or something like that. And the kind of the position has been, there's nothing wrong with investing in those types of things, but we don't view them as sort of a core investment offering. So if you want to have something like that, we would suggest opening up an individual retirement account, an IRA, or you could open up a taxable account and purchase it there. Again, along those lines of kind of supplementing what we're doing with the 401k program. We would probably view that as I guess you could say a more exotic investment. So that's probably something that we would not consider core. So certainly buy it if you're interested in it, but I don't foresee us offering something that would be specific in that way.
Okay, and I presume then the same response would apply to a REIT or a real estate investment trust funds.
Correct. Correct.
Okay. In terms of another type of, looks like this person has a question about possibly adding, it's a specific fund, it's the Fidelity's bank loan fund, as an alternative to a pure money market to hedge against rising interest rates.
Yeah, I mean the bank loan fund, again, so bank loans are sort of an alternative to T-bills, so it's short-term loans that banks make to businesses. The issue with bank loans, ultimately is that they tend to get valued as junk bond debt. So they aren't necessarily viewed as investment grade. So we may have a little bit of concern about offering that, and trying to categorize it as a money market alternative. It really isn't a money market alternative. There is definitely a potential for risk with the bank loan fund. You can lose money with it. We may explore perhaps a short-term bond fund or something like that, but I don't know if we would go to bank loan or floating rate is another way that it's called. We would probably keep something more investment grade for that.
Okay. Another question very similar, I think, probably to the other two questions about the REIT and the fossil fuel-free and ETF offerings. As opposed to the mutual fund offerings that we have. Do you expect us to have any offerings in that?
I mean, the ETF thing is a bit of a conundrum for the retirement plan industry in terms of offering ETFs as investment vehicles, and this again kind of comes down to more the trading element of it and valuing the ETFs, where they're priced essentially minute to minute while the markets are open. There are commissions that you have to pay to buy and sell the ETFs. So, I have not seen too many record keepers that have an ETF-based platform. Most of the kind of the 401k computer systems out there are really geared towards dealing with mutual funds. I think Fidelity does not have the capability, as it stands right now, to have ETFs be one of the investment vehicles per se. So until Fidelity can develop the technology around it, at least and people are probably saying, well, I'm buying ETFs in my IRA account. Absolutely, no issue with that. there do seem to be sort of issues that we run into for 401k purposes with trading the ETF. So that's a whole other discussion, but I don't see ETFs on the horizon anytime soon, per se. Back to the REIT piece or fossil-free fuel, or really kind of any other sort of specific slice of the economy. Again, I'd encourage people to do that outside of their retirement plan or outside of the 401k, because philosophically the attitude is really DeSoto is interested in offering sort of core basic building blocks as the investment options for the 401k, not so much things further out on the spectrum.
Okay, and I do want to point out one other thing, just as we still have everybody and it's coming up on the 3 o'clock hour. Kendall Storch and Arthur Gallagher, Longfellow Benefits, as many of you know them from the past, you can contact them anytime to talk about any questions that you have, or specifically regarding your 401k. So please reach out to them anytime. It doesn't have to be when they're on site, potentially at your facility or your location. So please, his contact information is available there, so take advantage of that. We're going to continue for another, I'll say probably about another 5 minutes to try and get through some more of these questions. But again, reach out to Kendall with any questions that you may have. Is there a tool on the Fidelity site to model the differences in take-home pay for contributions to a Roth 401k versus a traditional 401k?
There is, well, the answer is yes and no. The difference in take-home pay, you could use the same tool that I showed everybody earlier, and I mean the answer to that question is, in terms of what your take-home would be if you were making a Roth contribution, it'd be a 1-to-1 reduction. So all right, scroll back to the slide that I had before here. I think I know where this person is going with it, but I'll try and okay. So here, in this example, there wouldn't be two different numbers at the bottom, 144 and 101. If you're making a Roth contribution, you'd put in $144 into your 401k account, and your paycheck would go down $144 because it is an after-tax contribution. The calculator, the tool that they're probably referencing, is a tool to measure, are you better off contributing on a pre-tax basis or on a Roth basis, and trying to model that out. Yes, there is a tool, again, in the library, tools and calculators, there is a Roth calculator. The Roth calculator will run that sort of calculation for you.
Okay. And you had mentioned, I think before, about the 401k contribution, $18,000, and again, if you're over age 50, you can contribute an extra $6,000 here in 2016, as well as the $5,500 that you can contribute to a Roth IRA. I think it's probably important to note, and I think you had it on your slide as well, that there is a sliding scale in terms of how much of that $5,500 a person would be able to contribute, just based on what their earnings, their family earnings, would be for that year.
That's true. Yes, there is, for Roth IRA accounts, there is an income phase out, so you have to look to see basically how much money you make. If you make too much money, you can't make a Roth IRA contribution. So you can Google, income phase out Roth IRA, and it'll give you the grid, and it'll show you, whether you're filing singly or if you're filing jointly, what those income thresholds are, and how much of that $5,500 you can actually put in.
Okay, and then here's a great question, because we do work with Fidelity as our administrator for our 401k plan. Can I go to a local Fidelity advisor for suggestions, and is that a free service?
Yes, absolutely. So any of the Fidelity Investor Centers are available for any DeSoto employee. So if there's a local Fidelity Investor Center, you can go in, you can make an appointment, and you can speak with an investment counselor there. And that is a free service.
Okay. Another question is about the fund fees. is there any guidance, or is there some way that an employee can see what the fees are associated with the DS fund options, and how does that compare to what other companies provide?
You can see if you go into sort of the research and investments tab of the website, it'll pull up all the different funds, and there's a hyperlink on the fund name. If you click on that, it will take you to a fact sheet on the fund, and there's a section that says fees. So the fees will tell you what the expenses are associated with each of the different funds. There's the only expense that exists is the actual expense ratio of the fund, what it costs, what the price of the fund is. I can't remember off the top of my head if there's a percentile ranking on that fact sheet as to what percentile the expense ratio falls into. What I can tell you though is that we do benchmark the fees within the Dassault plan to get a sense of how competitive they are, and I would say our fees are extremely competitive, kind of across the board. So that is definitely something that we take a close look at, and we look at ways that we can try and reduce fees wherever possible.
Okay. Looks like on one of your slides, the annual returns you showed actual final returns, or does that subtract the annual maintenance charges for the respective number or for the respective funds?
Yes. So for the slide that has the returns on the Dassault funds, those are all net fees.
Okay. And again, so I am going to wrap up the call now. I know we're 5 minutes over, and many of you have asked questions that we haven't gotten to. I do want to reiterate that you can contact Kendall Storch at any time. So Kendall, if you want to move your slide back to your contact information. Again, Kendall's information is also available on the rewards@3ds.com site under the contact information. So you can contact him at any time to discuss any of the questions that we didn't get to today. I know there's a tremendous amount actually. Please take advantage of that. Again, in terms of this presentation, this recording, the slide deck, we will post out on the rewards@3ds.com site. There's a wealth section on the rewards@3ds.com site, and we typically will post that there, so you can find it there. If you have any other questions that either you don't feel comfortable asking Kendall about, or you want it's maybe more DS specific, you can certainly send an email to me as well, and we can discuss that further. But at this time, we're going to go ahead and close the call, and I thank you all for taking the time to attend today, and hopefully you found this worthwhile. Thank you.